Welcome back. The collapse of the two banks has completely muddled the interest rate scene and global financial markets. US two-year bond yields have fallen nearly 100 basis points in the past 3 trading days, while the 10-year bond yield in the US has fallen by 30 basis points over the past few days. Indian yields have also fallen by 10 basis points in the past 3 days. This after India's February inflation actually came in higher than expected at 6.44%, actually higher than the Reserve Bank's given mandate. So, will both the Fed and the Reserve Bank go into a pause mode as the markets are indicating? The Fed in March and the RBI in its April meeting? Is the worst over for US banks, or do more risks lurk out there? Should we prepare for slower than expected growth? I'm joined by Stephen Englander, the Global Head of G10 FX Research and North America Macro Strategy at Standard Chartered Bank, and Soumya Kanti Ghosh, the Group Chief Economic Advisor at State Bank of India. Gentlemen, thank you very much indeed for joining me. Steve, in particular, for staying up for us. Well, first up, what's the sense you're getting, Steve, about the banking scene? Is this idiosyncratic, as some of them have observed, and that the broad banking system will not give us trouble? Is kind of the worst over in terms of banking instability?
Well, first of all, good morning to you. And for once, I'm in the same time zone as you are, because I'm visiting India this week.
Okay,
and I'm
thank you.
speaking to you from my hotel room in Delhi. Look, you know, we've all become bank analysts over the last 36 hours, so you have to be particularly prudent about what you're saying. I think that that there is a problem, I think, that's been realized, which is that, when it comes to any kind of insecurity about banks, there's no upside to taking chances if your deposits aren't insured. And as a consequence, any bank where there's even the slightest perception of weakness, there's a risk that depositors are leaving. By U.S. law, I think they can only guarantee the uninsured deposits of banks that have been that have been taken over. So what they're doing is trying to indicate to the market and to depositors that they're 100% behind the remaining banks by making funds available for them so that they can meet any kind of deposit withdrawal through the discount window and other facilities. I think that when you look at it, last week the banks that were resolved were seen as being kind of unique, with very particular problems related to how they had grown and the structure of their portfolios. I think that there's probably some concern about a limited number of banks right now. The problem is, even if you say there are, maybe 25 more banks, probably relatively small, you don't know which 25 they are. So, all banks in certain categories are being tarnished. I think that what the authorities are trying to do is convey just how much they are behind the banking system and to stay any kind of mass withdrawal. So it's likely, I think, that I think bank stocks are going to be questionable for a while until this resolves.
Steve, actually,
but in
I have to
terms
veer
of being around the financial sector, I don't think that's going to persist.
I want to bring the conversation to what the Fed might do, therefore. There is a school of thought which believes that the Fed can't be seen to be, arm twisted by the markets. And given the jobs data and likely strong CPI data, it should stay the course. What's your sense? Will it relent? What are you expecting on March 22nd?
Look, we're still at 25 basis points for this meeting, although clearly the risk has shifted from 50 to 0 if it's not 25. I think that there are board members who would very much like to differentiate between the Fed's role of lender of last resort and the Fed's role in running the macroeconomy. But I would say that sentiment has deteriorated a lot, not just on the banking sector, but on activity over the last few days. And that's something that they might pay attention to. So we haven't changed our forecast of 25 basis points, but it's the forecast that we ran with for a long time, saying that March would be the pause. I mean, that's kind of the risk that the market is facing right now.
Fair point, fair point. Soumya, now to come to you. The Reserve Bank has a genuine dilemma. Inflation is high. What's your sense of what April might hold?
Yeah, thank you, Lata. I think April might be a very interesting dilemma, or I think might be a serious dilemma on the part of RBI, because we have already been now observing, because keeping aside the methodological issues regarding the CPI, I think the yesterday's number was on expected lines. In fact, we were expecting the same number, around 6.4%, which was released yesterday. But I think the good thing is that the March and April inflation numbers will be significantly benign. March could be around 5.5 to 5.6%. April could be around 4.5 to 4.7% if the current trends hold. In that case, the central bank will have two numbers on the table, not before April, but at least before June, so as to take a considered view of whether to go for a rate hike in April. Because we are already seeing signs of a distinct slowdown in the affordable housing segment, the retail segment, I think, and there is basically in the retail portfolios of given the fact that the EBLR has been instantaneous transmission, there has been some pressures also in terms of the on the consumers book. So for example, if you look at the affordable housing segment, that has declined from 60% in June 2022 to 45% today of the overall bank's portfolio, indicating that less and less people at the lower end are actually going for the loan. And these are all incremental loans, the fresh loans. So if I take that factors into consideration, and given the fact that the March 22 Fed decision is still an open decision, even though I believe that Fed could still go, this is our personal observation, that Fed could still go for a 25 basis point rate hike. The RBI could take all factors into consideration. And my sense is that it will be better to look through these cycle and not go for an immediate rate hike in April, rather than keep the stance hawkish, because we need to, the next couple of days will be very crucial, because we are calling it an idiosyncratic the behavior the markets are calling it, but given the number of the banks which are being impacted in terms of the share prices, the stock market route, I think it is better to look through the entire cycle and decide. So in my sense, a best policy at this point of time is to go for a pause and give out a communication to the market that it will be completely data dependent in the June policy.
Got it.
Because
the financial stability, that we are not done with hikes.
Yes, we are not done with hikes, because I think communication at this point of time is very important, because otherwise, if the Fed doesn't go for a hike on March, I am talking about a hypothetical possibility. So in that case, it will be an open and shut case for the Reserve Bank also, may not be considering a rate hike. So I think March 22
I got that, Soumya. I got that, Soumya. The input from Fed is important, but your guess is the Reserve Bank would be well placed to pause and say that I'm not done with hikes. But Steve, what about the balance of payments deficit that India has and the current account deficit? It's not large. January was almost a current account surplus for the month. But, there is a gap, and foreign funds are pulling out like no tomorrow. So you think an absence of a rate hike will trouble the currency in India?
First, I must clarify something I said before. I didn't mean to throw out a specific number of banks that might be under question in the U.S. What I meant to say is that the number of banks that are maybe under question is small relative to the totality of banks, but we don't know which ones really have issues. So the entire sector gets tarnished until that gets clarified. I think that, it's not an India-specific problem. It's a problem that all emerging market central banks are going to face right now, whether they can afford to push against the tide of risk aversion that's hitting the market and obviously putting some pressure on their currencies, or whether this is going to blow over. I think, in the medium term, it will blow over, that it doesn't seem to be a global phenomenon, and, to a strong degree, to a high degree, that the kinds of exposures we saw with these specific banks in the US are replicated. But I think that there could be, periods, and again, if the market doesn't stabilize, it could be periods of acute pressure, which would force central banks to act. But I think that they're hoping that they won't have to.
Okay. No, fair point. Soumya, what does all this do to growth? I mean, both psychologically and practically, because, you may not get so many global orders, which affects tech companies, which affects consumption by a large employed workforce in India. You think we should be prepared for less than 6% growth in FY24?
No, I think as of now, we are still holding to a 6.2% growth forecast for next year. But given the rapidly evolving scenario in the global landscape, and things are very fluid right now, and at the end of the day, even though this crisis maybe still I would call it a localized, because the local area banks in US are getting significantly impacted. But I think things could blow up at any point of time. And so my sense is that there could be possibility of growth declining. Already we are seeing signs, as I said to you, that there has been a slowdown in the affordable housing segment, which is basically has been holding up the loan growth of the housing sector in the last 1 year or last 2 years, even the low interest rate scenario. So that could be one of the casualties over here. But the second thing, Lata, which I would like to point out, I think the market perception and the global central bank action are actually very different at this point of time. I think the market is factoring in that it will be higher for longer because we can go for a lower for longer. I think at some point of time, this perception in India also and in our developed economies need to change, because if you need to hike, you need to hike now. If you need to cut, you need to cut now. There is no correlation between higher for longer now, which could lead to a lower for longer at a later date. So this perception and reality must merge at some point of time in terms of a rational decision, and hopefully the central banks will do their job in terms of guiding the markets through these uncertain times in terms of a better communication.
I agree. Yeah, and we are always ready to beat them on hindsight with hindsight wisdom. Very quickly, Steve, do you think the attitude towards India can change? A somewhat more resilient and domestically focused market. So do you see funds returning at some point faster than it would return to other countries?
I think that there's a risk they'll return faster than they leave if the Fed succeeds in stabilizing expectations, because what will be left of this will be the view that they can't take rates beyond a certain distance, that there's a fragility possibly there that they hadn't recognized. And that's very good for emerging market economies. But it may not be this week or this month. But once that sector gets stabilized and the fear is past, but we're left with a lower path for short-term rates and longer-term rates much lower than they would have been. That's a very positive signal for emerging markets.
Right. Well, we hope that's how it pans out, and we will not have to see extended instability. Stephen Glender, Soumya Kanti Ghosh, thank you very much for joining us and giving us your perspective. Out of time on Bazaar, Chartbusters is up next after a break.